Your RIN TV on-demand video will begin shortly. Meanwhile, be sure to register for RIN TV alerts by clicking on the link below. Dr. Robert Hartwig from the Insurance Information Institute was asked to speak before the House Financial Services Subcommittee on Insurance, Housing, and Community Opportunity. The hearing focused on the impact of Dodd-Frank's insurance regulations. Here are excerpts of his testimony.
In 2010, worldwide combined property, casualty, and life insurance premiums totaled $4.3 trillion, or about 6.9% of global GDP. Collectively, these premiums reflect the transfer of hundreds of trillions of dollars of risk exposure to insurance companies around the world. It's therefore critical that any and all regulations impacting the industry, including Dodd-Frank, not in any way diminish the ability of the insurer to play the key role that it has played for centuries. Now, despite difficult economic times in recent years, the insurance industry's capital resources are at or near all-time record highs and are growing. The strength of the industry is without parallel within the financial services segment, and property, casualty, and virtually all life insurers, unlike banks, were able to operate normally throughout the entirety of the financial crisis and have continued to do so since. It's important to recognize that in a decade leading up to the passage of the Dodd-Frank Act in 2010, the property casualty insurance industry experienced claim events in its history and weathered the worst recession since the Great Depression. Indeed, not a single traditional property casualty insurer or reinsurer failed as a result of the financial crisis, nor did a single legitimate claim go unpaid. In contrast, during the financial crisis and its aftermath, more than 400 banks failed, including the largest failures in U.S. history. Consequently, the financial industry regulations adopted in the wake of the crisis must avoid imposing bank-centric regulations on the insurance industry, whose operating record and business model are clearly distinct from that of the banking sector.